Welcome to FRK 321 Foreign Exchange Transactions, lecture number 1. With foreign exchange transactions, we will look at unhedged transactions in terms of IAS 21. We will also look at hedged transactions of foreign exchange, which will, because it's hedged, we will also have to look at financial instruments, which is IFRS 9. Your specific outcome: you should be able to account for and disclose all aspects relating to foreign currency exchange rates. Your assessment criteria: these are all given to you in your handout. Please go and look at the handout and click up, or if you've got a printed one, go through that, look at all those criteria and make sure that you understand the criteria and know what is required of you. Right. What can you expect further? Theory and definitions, definitely journal entries, which is very important in this topic. You have to know the conversion of financial statements, and then of course disclosure. Disclosure of the items that you have done in terms of foreign exchange currency and of hedging. An entity can get involved in foreign exchange activities in one of two ways. Firstly, you can have direct foreign exchange transactions, such as buying and selling of items, goods or services, and then being paid in foreign currency or paying foreign currency for that service or goods. Or you can conduct foreign activities through a foreign operation, such as a foreign subsidiary or maybe a branch in another country. It is important that you know the difference between a functional and a presentation currency. An entity's functional currency is the currency in which the items in the financial statements are measured. Now, an entity does not have a choice in respect of its functional currency. All the items in the financial statements must be measured in the currency of the entity's primary economic environment. In other words, in that environment where you are doing your business, that currency which is relevant there is the one that you will use as your functional currency. The presentation currency is the one which the financial statements are presented in. Now, here you have a choice. You can, in respect of your presentation currency, the entity may present its financial statements in any currency that it intends or wants to. The objectives: the accounting treatment of a foreign currency transaction and the translation of your financial statements into a presentation currency, or the translation of financial statements of a foreign operation or a foreign branch. Let's look at the definitions. Foreign currency transaction is a transaction which is incurred and settled in a foreign currency. As you saw previously, the buying and selling of goods and services in that foreign currency, the borrowing and lending of funds in a foreign currency, and also assets acquired and liabilities incurred in a foreign currency. Definition of an exchange rate: the rate at which the currency of two countries can be exchanged. Usually for accounting we distinguish between three types of currency: the spot rate, the closing rate, the forward rate. The spot rate is, as the word says, this rate at a specific date or time. Today's spot rate is X amount. The closing rate, which will be the rate at the end of a certain period, usually the end of a reporting period, it will be the specific rate on that date. And then the forward rate, which we mostly find in the forward exchange contract, which is your exchange contract for buying or selling currency. Let's have a look at the question in this regard. The rate at which a foreign currency can be exchanged between specific parties on a specific future date. Yes, that will be your forward rate, a future date. So that will be the forward rate, part C. Actual or current exchange rate on a specific date. A specific date will give you, no-brainer, a spot rate. And then finally a spot rate on financial statement or financial position date, a reporting period date, a future closing rate date, as the word says, closing rate, 3B. Monetary and non-monetary items. Monetary items represent money held and assets and liabilities to be received or paid in fixed or determinable amounts of money. All other assets and liabilities are non-monetary. Now this is very, very important that you know this definition so that you can apply it when you have to do currency. Your next question: is the following a monetary item or not? Accrued expenses? No. Prepaid expenses? Prepaid expenses will not be a monetary item. It will be a non-monetary item, because although it's cash that has been paid, it's already paid, and what you can receive for that in future will be either goods or services and not a monetary item. Transaction date, also a very, very important definition. Transaction date is the date on which the risks and rewards associated with ownership of the asset are transferred from the seller to the buyer. In this case, we have two items, free on board and cost insurance freight. Now, if goods are shipped free on board, that means that the company will produce the goods, they will ship it to you, and when it is loaded free on board at a port of entry, such as a ship or an aeroplane, on that day the risks and rewards of ownership will transfer to the buyer. The same with goods. When goods are shipped, cost, insurance and freight. Now in this case it can be either from the premises of the producer or from a port of entry. But once it is cost, insurance, freight, on that moment the transaction date will kick in and the risks and rewards will go over from the seller to the buyer. So the risk and rewards associated with ownership will only be transferred when the goods are dispatched. So please look at those items. When you see free on board or CIF, remember that will be your transaction date. Let's look at this explanatory example. On 1 January 20.5, A Limited placed the order for the purchase of a machinery at $20,000. This machinery was shipped free on board on 1 February 20.5, and the creditor is payable on 30 April 20.5. A Limited has a 31 March year end. Now what do we have to have a look at? Firstly, you're going to look at your timeline. So you have to draw up a timeline for this. So there you are, draw up your timeline. But before we continue with the timeline, let's just look at what information is given to us. So in this question, we gave you the exchange rate in the form of $1 equals 2 Rand 71. The next one, $1 equals 2 Rand 72.6. And that is the way that we will usually give you the exchange rate. But we can also give it in another format, as you can see here in the square. We can give it to you in the form of 1 Rand equals $0.369 or 1 Rand equals $0.36668. Just make sure in a question how this information is given to you. I will refer further how the calculations work, because this one has a bit more difficult calculation than this one. So now that you have your exchange rates available and you've drawn up your timeline, let's start with the 1 January timeline. Now you must say what happened in 1 January, and the question wants you to do journals. So what journal will you do on 1 January 20.5? Think about that one. And then your next period there is 1 February. Now what happens on 1 February? On 1 February it was placed, shipped, free on board, as you can see there. So therefore, because it's free on board, shipped at that date, it is your transaction date. And the next date, now we have a year end in between. So again you will have to go and calculate the exchange rate and determine what profit or loss has been made, to state your financials. And then finally on 30 April you will then have the payment. So on each of those dates you will have to go and do an exchange rate calculation. The first one, let's recap, is on that date you will have a calculation when the asset is purchased, and then the year end, and so forth. So let us have a look at that right now. Firstly, our first journal, 1 January 20.5, there's no entry because no transaction has taken place. It's only the order date. Then on 1 February 20.5, we will have to recognize the transaction at the spot rate that prevailed at that date. So therefore, we will debit the machinery and we will credit the creditor with 54,520. So how did we calculate that? Let's just look at that first calculation there. Our $20,000 times 2 Rand 72.6 equals 54,520. That is if the exchange rate was given to you in that format. Now if the exchange rate was given to you in the other format, then you have to divide that answer by 20,000 by that rate. So that will be $20,000 divided by 0,3668, giving us 54,526. Now don't break your head about the 6 and the 0 because it is only rounding, and in a question we will take that into account. Then on the 31st of March, that will now be our year end. We have to adjust the monetary item. Remember now, the asset has been in our books at the exchange rate of the previous of the spot rate at the date of the transaction, and because the PPE is not a monetary item, it's a non-monetary item, it does not need adjustment in the future. Whereas the creditor is a monetary item, and for that reason we will now go and calculate and restate the creditor. So we will start off with a rate that was applicable on transaction date, and we already did that calculation. And then we will start off with a creditor at year end. So we take the spot rate or closing rate at year end, which is the 264, and that is the calculation we will make. Now you can just take the difference between the two, and you've got a foreign exchange profit that you made. Why? The creditor, we owe less to the creditor. Previously we actually owed the creditor in rand terms 54,500. Now we only owe the creditor 52,960. So therefore there's a profit there. Now we can also calculate this by taking the difference in the exchange rate and times that by the 20,000. But when you do this format, you must calculate the answer in full and calculate the answer in full. In this case again, 20,000 divided by 0,3668 gives us that figure there, and then on year end 20,000 divided by 0,3776, and we have that figure there. We get to more or less the same answer at that stage. On 30 April, the date of settlement, we actually have to do the same thing. Again, we will calculate the difference between the two, and again that will give us in this case, our foreign exchange loss. So there you have the journal. You will debit the foreign exchange loss and you will credit the creditor, which will adjust the creditor, and now the balance of the creditor will be this 53,600. Now you've only adjusted the creditor, so now you must make the payment. So how much is the payment? Again, spot rate at the date of payment, and we will calculate that figure there, and that will give us 53,600. So you debit the creditor with that amount. Now the creditor is out of your books, and of course you credit bank, being the payment of the debt.